Well, one, I do hope so, but I don't want to get too excited about this upcoming June summit. I was a little more excited about that earlier. I think Powell tempered that last week in his Atlanta speech. But I think just listening to your opening discussion, it's actually the combination of the Fed and China that I think is driving the market. It's definitely trade rhetoric stepping up, but the market is a little nervous that the Fed might screw this up if China and the U.S. go into a deeper battle. And I think that's where the real jitters are. I think we have we have a structure whereby the Fed could come in and stop
what
a lot of the ugliness.
Is that?
Look, I don't want to be scientific about it, but I think in the mid-2600s, we're probably talking about a Fed rate cut, and we're probably talking about another one every 4 or 5% from there for a little while, maybe even a little more. And I think the story of the market is that it's just nervous that this Fed, after what it did to everybody last December, might miss the ball again and miss what the market is telling it. And the market's telling it that it could get ugly with trade, that the Fed does have the power to stop that ugliness. But if they choose to be a little wishy-washy, and some of their comments, the transitory comment from Powell, didn't really sit that well with the market.
What do you tell clients who say, David, we just saw the 3-month, 10-year yield curve inversion get to the most negative? It's negative 12 basis points now, the worst since 2007, 13. Why should we ignore that? Why should we blow that off? Is it just because the curve is flat, or is there more to the story that the stock market is not processing yet?
I think it's like Bob Dahl was saying. I mean, inversions happen, and they're usually around 18 months early to predicting recessions. That's quite a long way, and markets tend to go up before that. So we still haven't seen 2s, 10s invert. We still haven't seen 5s, bonds invert. We have the highest point on the yield curve, I think, is 1-month LIBOR, which is a bit unusual. But I wouldn't get too worked up until I really see a 2s, 10s inversion. That's the one I've always looked at throughout my career. I also like looking at 5s, bonds. That really tells me the Fed is behind. The Fed's not behind now. The Fed is being kind of tested with the bond market, and we want to see what they're going to say. We want them not necessarily to even ease, but just tell us, hey, if things get ugly, we will ease. That's
well, we
enough.
know they will, though, right? I mean, they're data dependent. I mean, if they get really ugly, are they just going to sit on their hands?
Look, Scott, I agree with you. I actually think they will. But what Jay did last December really messed with the market's head. And so I think you've got a little bit of psychology that you're playing here. You want to get some dovish Fed speak. I think dovish Fed speak stops this out pretty quickly, even without a rate cut. And maybe that even kind of sends the 10-year note yield back up a little bit because people are pricing in more mistakes when they buy the long end.
If the Fed does do the cut that the market now seems to indicate they believe is likely by the end of this year, is that a tacit admission that the hike they did this past fourth quarter was a false move?
Look, I think they'll never admit that, John.
No,
I mean,
course,
they'll never admit that. I mean, I think most people looking back at the discussion about the balance sheet on autopilot would say that was a silly idea. That was something you should have never communicated. The hike itself, if it was couched in a balance sheet that was going to stop and no sort of a more neutral stance, probably would have never led to what we saw in December. Further, if you take it back to October when he talked about being a long way from neutral, if you would have walked that back, we probably never would have had to go through December. This was all communication error more than 25 basis points.
Maybe, but
or
in
not.
the Fed's defense, I mean, the first quarter, GDP was 3.2%. We're at a multi-decade low in unemployment. Everyone's saying the consumer's just fine. A lot of the retailers we talk to. This wouldn't be an environment for them to be necessarily dovish and talking about rate cuts, would
Sarah,
it?
they've missed their PCE inflation target by over 70 basis points a year for the last 7 years. They have a dual mandate, unemployment and inflation. We have a 3.6% unemployment rate, 50-year low, and the PCE inflation rate is 1.55%. What are they fighting? They are fighting a battle that doesn't make any sense on inflation. And the real risk is that we go into the next recession with a lot of disinflationary expectations built in, and they can't lower real rates fast enough to fight it. I think that's what this summit is about in June. I hope the guys around the table, like Charlie Evans, who's the host in Chicago, and Rich Clarida and John Williams, folks who've thought a lot about price level targeting, thought a lot about these inflation misses, Jim Bullard and the like, are going to really step up and go, hey, we have a problem here. Our models don't work. This inflation story is just a bogus story, and we need to really be thinking about things like insurance cuts, sooner rather than later. That's the story the market needs to hear. They don't even need to get the cut. And I think we'd be right back up at 2,900 pretty quickly.